So, welcome back to Unit uh, 2, and this is second part of the video, and second part of the unit. We'll be going through future trading mechanism. This is the last topic of this unit, and also the biggest one. You'll have to understand what is futures trading mechanism. Trading in futures has been realized as an important strategy for price risk aversion in the commodities. The purpose of futures trading is mainly price risk minimization, price discovery, and price dissemination. The commodity futures markets provide a means to transfer price risk between the person with a position in physical commodity or hedgers to speculators and arbitrageurs. Futures exchanges are successful based on the principle that hedgers may forego some profit potential in exchange for risk minimization, while speculators may take such risk with a view to gain from probable potential profits. Future contracts are future contracts typically have certain features such as the ability to extinguish positions through offset rather than actual delivery of the commodity. In addition, standardization of the contract terms makes future contracts more convenient for hedging. So, future contracts they do have the ability to extinguish positions through offset. Means there's just offset through a parallel transaction, opposite transactions made. So, in addition, standardization of contract terms make future contracts more convenient for hedging. So, it is more convenient tool for hedging. Traditionally, future contracts have been traded in an open outcry environment where the traders and brokers shout bids and offers in a trading bid or ring. With the advent of technology, trading in commodities as well as financial product futures has been migrating to electronic trading platforms through a computerized trading system. Standardized terms of futures including contract size, delivery month, last trading day, delivery location, and the specification of grades and quality of the commodity. The standardization enhances liquidity by making it possible for a large number of market participants to trade the same instrument. This liquidity makes the contract more useful for hedging. Clearinghouses. Futures trades that are made on an exchange are cleared through clearinghouses. When traders enter into the futures contract, he is technically buying from or selling to the clearinghouse rather than party with whom he executed the transaction on the trading floor or through an electronic platform. Margins. In the futures trading, the entire value of the contract need not be paid, but only a certain percentage of the contract value called margin is paid. Margins typically between 2% and 10% of the total value of the contract. There are different types of margin levied while trading in the futures. Initial margin is paid when the futures trader enters into a future position as specified by the futures exchange. Thereafter, the margin amount varies based on mark to market, and the margin amount will be adjusted automatically according to the changes in the future price. Special margin is levied in addition to the prevailing margin, typically when the price of the commodity becomes volatile beyond certain acceptable levels specified by the exchange or the regulator. What are the risk management strategies in future trading mechanism? Primary purpose of derivatives trading in commodities is aimed to reduce the price risk from the seasonal fluctuations. The strategies of the risk management include hedging, speculation, and arbitrage. What is hedging? Hedging is an economic function that helps to reduce the price risk in the commodity significantly, if not eliminate altogether. Hedging is the practice of offsetting the price risk inherent in any cash market position by taking an equal but opposite position in the futures market. Futures market believed to be originally developed to meet the requirements of the producers who want to hedge against the price risk arising from the seasonal fluctuations. However, the scope of commodity futures has expanded later with widespread participation of producers, traders, and users of commodities. Hedger is the person who has a position in the physical market and wants to avoid the risk. Hedging will be effective only when the following requirements are met. driven by demand and supply over a period. The prices of cash and futures market tend to move together. As the maturity date approaches, cash and future prices tend to converge or reach an acceptable difference. Process. Hedging in future market is a two-step process depending upon the hedge's cash market situation. First step, if the hedger is going to buy a commodity in the cash market at the later time, his first step is to buy futures contract. Or if he is going to sell in the cash commodity at the later time, his first step is hedging process to sell futures contract. Second step, when a cash market transaction takes place, the futures position is no longer needed for future price protection and should therefore be closed. Depending on the initial position taken long or short, hedger would offset his position by selling or buying back the futures contract. For example, in June, if a market expects an output of 100 tons of soybean on October, soybean prices in October are expected to rule relatively lower as it is harvesting season for the soybean. In order to hedge against the price fall, the farmer sells 100 contracts of 1 ton each at rupees 1347 in June. On the fall of the price to rupees 1216 per ton in October, he makes a profit of rupees 131 per ton. Speculations. Contrary to hedging, speculation involves risk with no cash market position. Speculators take risk that hedgers want to avoid with a motive to make profits and provide the necessary liquidity through bid offers that result into a continuous flow of transactions. Commodities are becoming increasingly attractive to investors as an alternative asset class that may allow reduction in overall risk of financial portfolio and enhance returns. Unlike in spot markets, he has to invest only a margin amount instead of total amount and can gain profits to the total extent. Arbitrage. A third category of market participant is the arbitrager. Arbitrage is a risk-less profit realized by simultaneous trading in two or more markets. However, arbitrage opportunities are very desirable but not easy to uncover as they do not last longer since the parties get adjusted soon with the buying and selling. Arbitrage is possible when one of the three conditions is met. The same asset must be traded at different prices in all the markets. Two assets with identical cash flows must trade at different prices. And an asset with a known price in the future must trade today at a different price than its future price, discounted at the risk-free interest rate. Basis and basis risk. Understanding basis risk is fundamental for hedging in futures trading. Basis is equal to spot minus futures price, when T is maturity period and T is a specific date. It is normally quoted as a premium or discount in relation to the cash price. If spot price is more than futures price, then basis is said to be over future and called premium. But if SP is less than future price, then basis is said to be under future and called discount. Example, on a particular day, October 1, if a trader purchased soybean in Indore market at a price of rupees 1180 per quintal, and on the same day October futures contract closed at rupees 1208 per quintal, then the basis could be calculated by subtracting the futures price from the spot price. The basis is partly determined by the interest or difference between margin deposit and the total value of the contract, and partly by storage costs. Thus, the future price for physical commodity are typically higher than the spot prices, a situation known as contango. Differences in quality and grade, as well as expectations about the future supply, also can affect the basis. If expected future supplies greatly exceed current supplies, future prices may be lower than the spot prices, a situation known as backwardation. Now, basis risk exists when futures and spot prices do not change in the same magnitude and may not converge at maturity on account of physical attributes of the commodity, including grade, location, and chemical composition, etc. It is now common that the market participants analyze their risk in mark-to-market perspective at date T. As a result, the basis risk is often defined as variance of the bases. where R is the correlation between the futures and the spot price series. S square is equal to this. There's no need to remember this equation, so you can leave this equation. The equation shows basic risk is 0 when variances between future and spot prices are identical and R equals 1. Practically, the correlation between spot and futures prices is the stringent factor and on which the magnitude of the basis risk depends. Price discovery. Future contracts are often relied upon for price discovery as well as for hedging. In many commodities, cash market participants typically base spot and forward prices on the future prices that are discovered in the competitive open auction market of the future exchange. This is considered to be an important economic purpose of future markets. In future markets, contracts such as stocks, interest rates, and foreign currency, the price discovery role of futures occurred in tandem with the cash market, which also contributes significantly to the price discovery. Players in the future market. There are three kinds of players: hedgers, speculators, and arbitrageurs. Hedgers, future markets believed to be originally developed to meet the requirement of the hedgers or producers who want to safeguard against the price risk. However, the scope of commodity futures is expanded later with widespread participation of producers and users of the commodities. Hedger is the person who basically wants to avoid the risk and enters into a contract with speculator. Speculators. Speculation is the opposite of hedging. Speculators, on the other hand, wish to take risk that hedgers want to avoid with a motive to make profit and provide the necessary liquidity through bids and offers that result into continuous flow of transactions. Commodities are becoming increasingly attractive to the investor and hedge fund managers as an alternative asset class that may allow reduction in the overall risk of the financial portfolio and enhance returns. Arbitrators, a third category of market participant, is the arbitrageurs. Arbitrage is a risk-less profit realized by simultaneous trading in two or more markets. However, arbitrage opportunities are very desirable but not easy to uncover as they do not last longer since the prices get adjusted soon with the buying and selling. So with this we come to end of the unit 2, and this is the end of the second part of unit 2. Best of luck. Keep reading, keep listening to these